All right, let's just jump right in. If you've been looking at the stock market lately and thinking, what on earth is going on? Well, you are definitely not alone. It feels like total whiplash, right? So today, we're going to dive into a really sharp analysis that helps explain these wild swings and, decode some of this chaos.
And really, this quote from someone on the front lines, a market participant quoted by Nomura, just nails it. The action in single stocks, they called it chaos. And that's the perfect word for it. We're not just talking volatile. We're talking about a world where everything feels upside down. Good news can sink a stock. Bad news can send it soaring. The old playbooks, they've been completely thrown out the window.
So the big question is, what's causing all this chaos? And more importantly, what does it mean for your money? Well, this analysis puts it perfectly. It's like trying to drive in a thick fog. But don't worry, today we're going to flip on the high beams. We're going to break down the two massive and kind of contradictory forces that are battling it out and pulling the market in totally different directions.
Okay, so let's tackle the first front in this market war, trying to figure out what on earth the Fed is signaling.
You see, Fed Chair Jerome Powell is sending some seriously mixed messages right now. It feels like he's trying to have it both ways. One day, the market gets all excited thinking, yes, a rate cut is definitely coming in December. But then, the very next day, Powell comes out and kind of pushes back on that idea. He's trying to reclaim what they call optionality, which is really just a fancy way of saying, hey, we want to keep our options open and not be pinned down. And as you can imagine, that just injects a massive amount of uncertainty into everything.
Okay, now here's where things get a little technical, but stick with me because it's super important. The Fed is talking about ending something called quantitative tightening, or QT for short. So what is that? Well, just think of it as the Fed basically vacuuming money out of the financial system to cool down the economy. They shrink their balance sheet, and that tightens things up.
So when the news broke that they might stop doing that, a lot of people started to freak out. You get these emails flying around, with the crazy SpongeBob font, screaming, they're about to start money printing. The fear is that the Fed is about to just crank up the money printers all over again. But is that really what's going on here?
And this is the absolute key takeaway. Ending QT is not, I repeat, not the same thing as starting QE or quantitative easing. They are two totally different things. So let's break it down. What the Fed is doing is basically stopping the vacuum. They're ending the tightening on December 1st, mainly to keep the money market stable. But what they are not doing, at least not yet, is turning on the fire hose. This isn't full-blown money printing designed to juice the economy and send stocks flying. Think of it more as a technical tweak, not some massive U-turn in policy.
All right, so that's the Fed. Now let's turn to our second front, because this one is happening inside the stock market itself. And honestly, it's even more wild. This is where you can really feel the chaos day to day.
The analysts have a name for what's going on: anti-dispersion. I know, it's a super technical sounding term, but the idea behind it is actually pretty simple. It describes a market that has become dangerously concentrated. It's that feeling where you look at the S&P 500 and think, hey, things look okay. But when you peek under the hood, you realize almost everything is actually struggling.
Here's the best way to picture it. You have this tiny group of mega tech stocks, you know them, the Magnificent Seven, and they're just shooting the lights out, posting these massive gains. But then you have, well, everyone else. The other 493 stocks in the S&P 500, as a group, they're actually slightly down for the year. So this one tiny group of stocks is literally carrying the entire market on its back. It's incredible.
And make no mistake, this is not just about cold, hard numbers. This whole thing is being fueled by some pretty extreme emotions. There's this thing Wall Street calls fear of the right tail, which is a fancy term for pure, uncut FOMO. It's people panic buying stocks that are already flying high because they're absolutely terrified of being left behind. You can see it in the options market, where everyone is betting these same stocks will go even higher. It's total capitulation. Investors are basically giving up on everything else just to pile into these few select names.
Okay, so you've got these two massive forces, right? On one hand, you have the Fed starting to sound a little more cautious, a little less eager to cut rates. And on the other hand, you have this absolutely frantic, concentrated mania in a handful of tech stocks. So, what happens when those two fronts collide? Well, according to this analysis, they're on a collision course, and it's setting the stage for a pullback.
And it's not just a guess. The analyst points to 4 specific catalysts that are all lining up right now. First, that hawkish turn from the Fed we just talked about. Second, everyone was hoping for some good news on China tariffs, and that's just fizzling out. Third, and this one is really interesting, even when the big AI companies report fantastic earnings, the market is kind of shrugging. And finally, you've got a stronger US dollar, which just tightens the financial screws on a global level.
So when you put all that together, this collision creates a very real window for a market pullback. Now, to be clear, no one's calling for a massive crash here. We're talking about a more tactical, short-term drop. Think something in the neighborhood of 3 to 5% over the next few weeks as some of the heat comes out of this mania.
But okay, beyond just a small, maybe even a healthy pullback, there's a much bigger, more structural risk brewing under the surface. And it all comes back to the one theme that's driving literally everything right now: AI.
And to really get our heads around this risk, we need to talk about one word: CAPEX. It stands for capital expenditure. All it means is the money that companies are spending on giant physical stuff, things like data centers, computer servers, and all those super high-end chips, the actual building blocks of AI.
And when I say they're spending money, I mean the numbers are just mind-boggling. The big tech giants are in an all-out arms race. You've got companies like Google and Microsoft dropping tens of billions of dollars, not per year, but per quarter, just to build out their AI infrastructure. The demand is so off the charts that one of the key memory chip makers, SK Hynix, is already saying their entire high-end supply for 2026 is completely sold out. That's 2 years from now. It's insane.
So all this spending creates what could be a really nasty double whammy for the market. Whammy number one: to pay for all this stuff, companies are taking on way more debt. That's fine now, but it could get really risky if borrowing costs go up. And then there's whammy number two, and this is a big one. For the last decade, the single biggest buyer of stocks was the companies themselves, doing share buybacks. But now, that cash isn't going to buybacks, it's going to CapEx, to servers and chips. You're effectively taking the market's biggest supporter out of the game, which leaves everything a lot more vulnerable.
And that brings us to the final, critical question that this analysis leaves us with. Think about it. You have a market being held up by just a handful of AI-related stocks, and that entire rally is being fueled by a spending boom of absolutely epic proportions. So what happens if the AI hype, the euphoria, gets way out ahead of the ability for these companies to actually pay for it all? You could be left with a market standing on a much, much weaker foundation. So the question we have to ask is the incredible AI boom of today accidentally setting the stage for the bust of tomorrow?